thanks so much, David. Appreciate you having us here. I am very excited about the conversation we are about to have. We've got some incredible guests with us today, some of the foremost experts and investors in private equity, growth equity, private credit, and an intersection with aerospace and defense tech in general. So I think you're in for a treat. Certainly an honor for me to be able to host this conversation, having been on the outside in startups and on the inside as part of the investment committee at the Department of Defense, as we think about how to spend about $750 billion a year, and running the diligence teams that were evaluating those choices that we had. And a privilege to be now here on the outside, having left with a strong and compelling conviction that we need to increase capital investments in our economy, in the U.S. and allies and partners, for many reasons, both commercially and from national security. So with that, let me open it up here for our panel of great experts from a number of firms here. I'd like to have each individual briefly introduce themselves. I'll go through, call it name by name. We'll start with Daniel here in a moment. And to open us up today, as we think about this, I would love for you to say, who you are, and what your firm is interested in, and what you particularly sort of do and your scope is of the firm. So Daniel, we'll start with you, please.
Sure. Thanks, Preston. Thanks for having me. Nice to see everybody. I'm Daniel Charnoff. I'm a principal at Bain Capital Private Equity. I oversee our efforts in diversified industrials as well as aero and defense in North America. Bain Capital is a large global asset manager. We manage just over $180 billion at the moment, of which about 80 is in our core global private equity business. In that business, we invest across the wide range of industries and asset classes. So sort of anything and everything is kind of within the scope. For me, the focus is on the wide range of industrials, including aerospace and defense.
Fantastic, Daniel. Thanks so much for coming to be with us today. David Kaden.
Sure. Hi, Preston. Thanks a lot. So I'm David Kaden. I'm a partner at Blackstone. I look after investments out of our tactical opportunities business, which is a global opportunistic investor. I look at opportunities across advanced technologies, which includes aerospace, defense, industrial technology, transportation and logistics, some healthcare, sort of a wide range of ways in which new technologies are reshaping the commercial landscape. Blackstone itself is the world's largest alternative asset manager. We've about $1 trillion in assets under management, and pockets of capital that look at everything from institutional credit all the way through large-scale public buyouts.
Great, thanks, David. Appreciate you making the time to be here today. Kirk, you're up.
Thanks, Preston. Good to see everybody, and excited to have this conversation. I'm a managing partner at A&D Investment Partners. We're focused on aerospace and national security companies, mostly in the middle market. I focus my time on the national security bucket. Pretty agnostic in terms of types of companies. We can be very forward-thinking around technology, but also can be thinking about way upstream in terms of the market, investing in base materials. We're focused in late stage buyout. That's most of our AUM, is about $5.5 billion. We also invest in venture capital and growth equity.
Fantastic. Thanks, Kirk. Appreciate that intro. And Richard, over to you.
Thanks, Preston. Thanks for the opportunity to join you all. So I'm Richard Wells. I'm a partner at Insight Partners. We're a specialist firm focused on growth capital and focused on software. And I've been here for about 20 years. I've also been the sponsor of our effort in the national security arena, which is pretty new for us and still relatively modest relative to our scale. And we started that really a couple of years ago.
Yeah, fantastic. Thanks, Richard. So I think one of the things that I think is fantastic about this crew, we've got some extremely senior individuals at some of the most influential private equity firms that we have on the planet, and so we get to hear from them. We're gonna have a few lenses as we think about in this hour. We're going to think about sort of private equity classes in general, and the state of that and the future of that, and then we'll hit more on the wave tops of defense and aerospace and defense in particular as we round out the conversation. Given that we're talking to a number of folks that are watching and listening that are serving in the defense community or government community on Capitol Hill in an elected office or as staffers, and companies that are interested in serving them, there's a general sort of sense of mission or purpose behind the folks that are listening here. I thought it'd be helpful if we could hear from each of you that you could have chosen to work in a variety of fields. You picked in certainly a lucrative career, but a very difficult and challenging career in focus areas in industrials or defense that you could have gone in other areas. So would love for each of you the opportunity to share with us sort of the why and what is the mission behind why you're doing what you're doing at the firm you're doing it. And we'll just go in the same order. Daniel, if you would mind kicking us off.
Sure. Well, I'd say, Preston, I would answer the question, sort of there are multiple questions embedded in that question. One is why private equity, and other is why industrials or why A&D. I think for me, the why private equity, it is sort of endlessly interesting. I get to deal with a pretty wide range of topics in any given day across, multiple businesses. And come across really talented people in a wide range of domains, most days, and that makes for a really rewarding, I think, career experience, and a really kind of constantly challenging one in which I have to keep learning to get better. So that's been, I think, for me, the most appealing part of the career. Within private equity, I think industrial is a really interesting area. First of all, it's just kind of cool. I'm a geek about manufacturing and walking plants and seeing, physical stuff move around. I think that's fun. And I also think it's a very attractive area for investment, in particular for investors to build a career. It's probably got the best supply-demand imbalance of talent, I would say, of any of the sectors that we invest in at Bain Capital. There's not... it's a little bit less crowded than technology or consumer tend to be, but it's a huge part of the economy. It's where a lot of value creation is happening. And it's also, specific to this conversation, it's the locus of a lot of innovation. So I think, over the last 20 to 30 years, certainly software was a huge piece of, where growth and innovation were happening. I think one of the things you've seen the market appreciate over the last few years is increasing innovation in the physical world, and whether that's emergence of renewables, a real inflection in EV adoption, a range of industrial technologies kind of penetrating into defense applications and otherwise. It's actually quite a dynamic space, but it's one that maybe young investors don't pay as much attention to or clamor to get into quite as much. So I think that makes for an attractive investment landscape.
Yeah, fantastic, Daniel. And I think you all heard it here first, that PE is not about financial engineering or spreadsheets, but it's also about the manufacturing and production floor and building product and value. So great, David.
Yeah, sounds great. So I came to Blackstone from the government, and my last job in the government was on the National Security Council, and my first bunch of years at Blackstone had nothing to do with national security adjacent businesses. But one of the things that we try and do as a firm is look at the relative balance of economic activity around the world, and make sure that we are in the right neighborhoods. And I think over the last decade, we have increased our exposure to national security adjacent businesses because we see it as a good neighborhood. We see it as a good neighborhood for a couple of reasons. One, I think as we've talked about for the last 2 days, and we'll probably talk about a little more over the next hour, there are more opportunities for private capital to play an important role in giving companies of all sizes, young, old, dynamic, and those that are just an important part of the industrial base, the financial oxygen that they need to grow and provide the support to whatever mission they're a part of serving today than there have ever been. And there's actually more private interest in providing capital into this space, I think, than there's ever been. And that's because the opportunity there exists to make an attractive financial return. And so I think at Blackstone, we saw that opportunity as driven by long structural tailwinds that merited us spending a lot more time thinking about how we wanted to be exposed to that across different parts of the capital structure, right? Credit, opportunistic, and kind of mainland equity. And so it's been fun to be a part of that. But I think it's ultimately driven by the underlying attractiveness of the space over a really long time.
Yeah, great. Thanks, David. It's great to hear too about starting in one area and moving into a different area. We're going to get back later in the conversation to what extent is it a good neighborhood. So hold that thought, and we're going to get back and dive into that a bit later. Kirk.
Yeah, I'm a firm believer that you're excellent in the things you love to do, you have passion for. We have passion for aerospace and national security at AE. That's the background of everyone here, whether they ran companies or invested in these companies. So that we in our free time, we like to look at jet engines. We like to go to rocket launches. We like to fly drones. That's the stuff we like to do, right? So I think that passion flows into our professional lives. Outside of, like, obviously everybody's trying to make a living and do well in their careers. We love what we do, right? And I'd say the other part is we have a focus on family founder-owned businesses. We love being the first institutional capital in the companies. We love being partners with families and founders. That's something that we have a lot of passion for. It's their life story and what they poured their time and resources into. We get to be part of that journey. That's really something we have a lot of passion for. And look, we have a passion for the mission, right? It's important to us. We think a key competitive advantage we have versus our adversaries is our capitalistic economy and our venture capital and private equity capital source. We think that's an important part of the U.S. Advantage, and we like to be a part of that. So I think we'll get into the specifics of why we think that, but that's why we do what we do when I do what I do.
Yeah, fantastic, Kirk. Thanks. And after the broadcast here, I'm happy to direct you to our recruitment team at the U.S. Air Force and Space Force, where you could actually do all those things in the seat if you want to. So we'll talk later. Richard, over to you.
So investing in growth capital and in growth stage technology companies, look, you can't pick something that's been more dynamic or growthful over the last 20 years. And I probably tripped and fell into it. I'm not a technologist by training. And look, sometimes better to be lucky than good. When you just so happens you came into it as software started eating the world over the last couple decades. The way I came to the national security world was fairly straightforward. I don't have a background in it, besides maybe reading too many Tom Clancy novels when I was younger. And then, however, my dad was a Vietnam veteran. My mom's an immigrant. There's no way I would, from where I started, where I would be if it was any other country but the United States. So always grew up very well aware of that. And did think about the service academies for college, decided I was tired of being poor, so went the commercial route. And but I never forgot that and became involved once I had 2 nickels to rub together with a couple nonprofits that have focused on helping our veterans, particularly the folks that just served in the wars of the last 20 years, with the Semper Fi Fund and then the Honor Foundation, and have really gotten been fortunate enough to support them and as they build their organizations for scale. So that's really how I came originally to this topic. But look, at the end of the day, I think Daniel's not wrong. I think we're very well aware that the unit of, as software continues to eat the world, the unit of consumption may no longer just be a license for a SaaS application. It could come in the form of a molecule, could come in the form of a fintech application. Probably won't come in the form of a crypto protocol, but you never know. Bitcoin's up again. And then it could come in the form of these other units. So that was really where, and we had some in-house expertise around some of these topics. So that had helped our portfolio. A big part of what we do is help our companies kind of move through their awkward teenage years of being a startup to something that is a real company, can sustain growth at scale. So that's how it all came together. And, candidly, I think we're still figuring it out. I think, we made a number of investments. I think, lived the hard realities. And I think we're still exploring what this big onflow of venture capital, early stage venture capital is going to yield in terms of ingredients to build real companies over the next number of years.
That's great. And certainly appreciate the head nod to the crypto challenge there as well, which I feel your pain. So, okay, Richard, I'm going to stick with you for the starting us off for the next one, but everybody may want to mute your mics for this question here. So I'm going to give you a quote from Senator Warren. She says, private equity firms were already gutting companies and killing jobs before COVID-19, and now they're drooling over companies to exploit during the crisis. Private equity firms get rich off of stripping assets from companies and loading them up with debt and leaving workers, consumers, and whole communities in the dust. End quote. We've just spent time thinking about the mission and purpose behind what each of you do. So would love us to talk a little bit about what's private equity's role, what's its responsibility here, if it has any, in strengthening the U.S. And its partners in technology or industrials in the areas that you care about. Richard, I'll have you kick us off.
Yeah, I mean, I think you can go from the theoretical in terms of, I'd say, when you go through, whether it's the aftermath of the financial crisis or even when you see some of the challenges that are emerging under the hood of the Chinese economy, that's at least what we know in the public realm. I think the notion of marking to market and capitalist forces making things happen and making things more durable and better. Yeah, sometimes it can be rough during the period of transition or change, but I think ultimately, personally, the economy is probably better for it. I think look, the more specifically though, and practically, what I'm focused on in general, and then in this realm is, and what we spend all our time around is taking a product that is real, and we know it's real because some customers have bought it and it's growing and there's some good people in that company, and then trying to turn that into something that is a business that's capable of sustaining growth at scale, and basically taking capital and expertise to that table to do that with. And we're not the brightest bulbs, but we've been doing this over and over for decades. So we just have discovered walls by ramming our faces into it. So we're able to bring that to our portfolio companies, and hopefully they're able to help them avoid running their faces into walls. I think generally that is not a bad thing. I mean, our metric of success is we invest in a company that was a certain size. Now it's a hell of a lot bigger. Usually it means there's a hell of a lot more employees. Just about every office I walk into when we're getting ready to exit a company is a hell of a lot bigger than the office we walked into. Usually way nicer too, than the ones at the time of our investment. And so, and look, I think as it relates to this particular sector too, we are trying to figure out how to invest capital into that kind of stage of company in the national security domain. I think if we're able to find investments and put them through that cycle, that's great. And by the way, if we're not, that will be important feedback for the industry to get better. Otherwise, we're just you're not going to attract more capital, and you're not going to be able to perpetuate the growth that you could if you did. So it's a biased view, but
yeah, thanks, Richard. Not everybody has to respond, but I would love if somebody else would like to chime in on this one.
Sure, Preston, I'm happy to give some thoughts. So look, I agree with Richard. As we have spent more time in this space, we spend more time talking to operators and folks on the execution side, to authorizers and folks on the appropriation side, and the acquisition professionals involved across the areas in which our portfolio companies have direct engagement with the government, or sometimes where they're deeper in the supply chain. And almost all of those people want more private capital to go into this part of the economy. They see opportunities to bring technology from the commercial side of the world into the public side of the world. They see holes in investments that the industrial base is making without private capital, and they see opportunities around the world to use private capital to strengthen our hand in terms of how the industrial base supports our national security objectives. So I think if you have private investors who are interested in being a part of that and are looking to create those outcomes, I think the politics, hopefully, at the end of the day, will take care of itself. We certainly see that, where we back businesses and our partners who, to a T, are extremely mission-driven, which actually makes them wonderful people to partner with. That those businesses seem to have really good relationships with their customers, and those customers are thankful that there's more and more capital flowing into this space. In our experience, I think as Richard noted, we're still early days here, and there have been lots of ideas that have attracted capital that are still in their infancy or maybe teenagerhood, and we'll see how that goes. Right, not all of them are going to be successes, and not all of the calibrations that have been made as to the appropriate valuations to put on this technology before it gets adopted by the government will be correct. And we could have a long conversation, and maybe we will, about what we've learned about how the government acquisition apparatus works in ways that could be changed or modified to support more private capital. So there's a lot to learn, I think, on both sides, but I think it's hard to make the case that private capital isn't helpful, or at least as long as we have folks on the other side who are encouraging us to look at this seriously, we're interested in doing so because we think that there are good opportunities.
I agree.
Yeah, go ahead.
The only thing I would add to that is, I think a dynamic and entrepreneurial kind of capitalist economy is a critical aspect of national defense, but also just one of the things that makes this a great country to live in. And to me, the private stewardship of capital is integral to that dynamic entrepreneurial economy. And Kirk mentioned earlier the concept of being the first private capital in buying family businesses. That's something that Bain Capital also prides itself on, and we try to have a decent chunk of each of our funds partnering with founders to sort of help create the next best version of their businesses. I think one of many reasons that private capital is critical to sustaining entrepreneurialism is, number one, it gives those founders an incentive to start the businesses, and then number two, it's often those partnerships that kind of ensure that the businesses that they founded will outlive their own careers. Maybe there's not somebody ready to kind of inherit the business, and so professionalizing it is kind of key to creating long-term sustainability. So I would say that's a sort of a critical part of the value that private capital brings to the overall economy and to the defense space in particular.
Yeah, I think those are great answers. I think PE is good. Just don't buy Subway sandwich. That's I think the lesson from the Hill here. Kirk, I'll have you kind of start us on the next one. I when I left and wrote the Defying Gravity paper with my team, I sort of agreed with the thesis that you all have just said, which is that it's impossible for the U.S. government and its allies to be able to sufficiently bridge the gap between new entrants or early stage or VC and sort of the big programs inside the defense arena. Therefore, something needs to be able to span the gap. A bridge needs to be made. One clear opportunity here that helps companies, people, Wall Street to Main Street is private capital helping to fill in that gap. So I'm sort of with you on the potential here, used responsibly. That said, over the last year, S&P's latest report says that private equity transactions have declined by about 35% last year and the year before that, going from a peak of about $1 trillion of transactions to under about $500 billion worth. Deal counts cut in half each year, all of which are lower than 2019 before the pandemic. So at the same time, it's harder, as perhaps many of you are also feeling, to be able to raise funds from LPs and then deploy that capital. So question, Kirk, you can kind of kick us off here. Is we have all of these sort of dynamics happening at the same time, yet I think we're very reliant on private capital to solve some of these challenges from a commercial and a national security perspective. So what signals are you looking for to get deal making back on track, and LPs are looking for to start sort of strengthening their investments again?
Yeah, I mean, look, I think you had last year and somewhat the year before, right, denominator effect of public equities coming down, so the asset allocators had to reduce their exposure to private capital. So I think what you'll see this year and maybe going forward, right, as public equities rebounded last year, right, you'll have the reverse happen, right, where there will be asset allocators looking to expand exposure to private capital. I think interest rates obviously are a factor, right, in deal making. As interest rates went up over the last 24 months, right? That hurt deal making, that hurt valuations broadly across all deal making. I think we're still seeing a lot of activity in what we're focused on, national security and commercial aerospace. We're seeing several large transactions happening. We were active in a few transactions. I know some others on the phone here or on the call here have also had some activity last year. So I think we're seeing still interest in private capital. I think it's taking longer to raise funds, but the best managers and I'd say national security focused investments are still getting funded and deals are still getting done.
Daniel.
No, I agree with Kirk. Look, I think things that are expensive become scarce and things that are cheap become abundant. Capital has grown more expensive, so it has grown a bit scarcer. I think that's true across asset classes, including private equity. We tend to lag a little bit some of the other asset classes just because of the denominator effect that Kirk mentioned, and because our valuations tend to move a little slower than maybe they should. But I think it's a cyclical industry. It's going through a cycle. The one thing I would point out here is if you look at the fundraising activity over the last year, certainly LPs are allocating fewer dollars to the sector. That's not evenly dispersed. So rather than everybody's next fund shrinking by 20% or 30%, what you tend to see is some managers continuing to grow and others failing to raise funds or with far sharper cutbacks. And so I think these cycles tend to kind of surface performance issues where those exist and reward managers that have been disciplined and focused. So hopefully everyone on this call is in that latter bucket. We'll see as the next couple of years play out, I'm sure. But I think it's sort of part of the natural cadence of the industry is to go through these cycles every once in a while, and certainly a higher interest rate environment is going to catalyze one.
Yeah, thanks, Daniel. And I'd like to sort of inside the same category, think for a few minutes about growth equity inside private equity. We'll go to Richard and then David on this one. So sort of as according to the last sort of public sort of release here. Blackstone's got a growth fund, raised a second fund, about 20% less than the first fund, so 4 billion versus 5 billion, about 5 billion in dry powder. Insight Partners similarly was shooting for, I think, a $20 billion fund, publicly said, look, there's a great tech reset, I think was the quote from Insight leadership, and reduced the target down to 15 billion. Much of what we're talking about in this bridge is going to fall into some of that growth capital. Maybe it's not quite ready for buyout or control. Is growth equity sort of a dying class? What are you looking for to be able to get that growth engine moving again? And I'll go to Richard first and then David.
Yeah, I mean, it is growth capital is in the technology industry, where it pretty much lies, is going to resize as we adjust from a lot of end of cycle behaviors, and no one ever knows it's the end of the cycle until it's the end of the cycle. So we'll call it late cycle behaviors to we're at the beginning of a new cycle. So and so that means you have huge swaths that were there and really impacted the market in a lot of different ways, from crossover funds and basically the public sector moving, the public investor market moving in. I think that's gone. I think there's also been huge swelling in the very early stage venture market. I think that's going to contract because most of that was from individuals and first-time managers or second-time managers. And then you just have a bunch of companies that were not built the right way. And so it's going to be a period of consolidation. And consolidation isn't pretty as an industry works through it. All that said, look, whatever the fund sizes ultimately end up being, it probably makes sense that we don't need as much money as we might have thought we needed a couple of years ago. And then when you've produced consistent returns over 15 plus years, you're going to 15, 20 years, you're going to be able to raise more. And I think any significant asset allocator will sit there and go, yeah, so maybe I don't want to do the crossover strategy. Maybe I don't want to do this or that, but really, I'm not going to have anything in growth at all. That makes no sense. And so, and I think where we are is, in a lot of ways, what happens when you go through this end of cycle to the beginning of a new one is you go back to your basics. So if I look at the investments that we've done over the last 18 months, they are exactly of the ilk that you would have seen over the last, basically where Insight built its track record and reputation. But you continue to adjust too. So we are very eagerly looking for, out of these cycles comes a new wave. And so we are very actively pressing that market with our full force and scale, looking for what those next areas of growth are going to be, so we can pounce and then help these companies build. And that's one of the reasons why I continue to spend some time in this sector of national security, although we'll get into, it's really hard.
Thanks, Richard. David?
Yeah, I mean, look, I think that I kind of agree with Richard. I don't think the growth equity is gonna go away. In fact, in the current environment, we see an enormous amount of demand, both from limited partners and from companies that need growth equity. It may be that valuations are more rational, which is probably a good thing. I think that if I'm listening to this conference and thinking about the application to national security, the kinds of companies that are raising capital at various stages that are applicable to national security are operating in a different framework than the rest of the economy. And so while they're influenced by macroeconomic factors and the broader market is going to determine the cost of capital for many of them, I do think it's important to kind of zero in on what is the state of those businesses, because some of them are benefiting, and in some cases maybe hurting from acyclical factors that are driven by the unique need that the customer has for what they sell or could do for them at any given moment, that is detached from how you price some high growth financial, technology business or some new commercial products company. And so, for us, we've actually spent a lot less time applying our growth equity dollars to national security adjacent businesses and focused our national security adjacent investments on areas where the technology is more proven, the business model is more proven, there are real earnings that the business generates, and the question is scale, right? How do you get from a business that has proven they have something that they want to buy and turn it into a company that has enduring value and maybe will one day become a core part of the industrial base? That's been a model where we thought that our capital was solving a problem, and I think that's been more of our focus in part because there were so many other challenges associated with closing the business case around some of the more growth equity oriented investments, that when you pile those valuations on top of some of those operational issues, we just struggled with those in the national security adjacent domain. And I think so I see all of that sort of continuing as it goes forward, right? There'll be growth capital, there'll be more private credit, there'll be more equity capital for all of these businesses, but there will be differentiation among those businesses that prove that they have a business model that is enduring and successful, and it will be harder to raise capital for businesses that are more speculative, and that ultimately may be a healthy thing, both for the industry and the country, and certainly the market.
Yeah, I love the way you ended there, and I want to take our general conversation in that direction. Before we get there, David, since you sit at a fund that has multiple strategies in TAC Ops at Blackstone, if you could just talk for just a minute about, and you mentioned this, private credit. So Blackstone, you said hit the $1 trillion mark, which is fantastic. About equal amounts now in private equity and private credit. The State Street Index has private credit beating private equity returns in 7 of the last 8 quarters. Is private credit going to eventually eclipse private equity? What do you think the future looks like there? And then after you answer, we'll turn it to another question focused on defense.
Yeah, so I think this is, I think we were one of the first to call it a golden age for private credit, and we believe that, and we think that the macroeconomic fundamentals and some of the regulatory limitations in the core banking system do create opportunities for private credit that didn't exist before, and it will be a wonderful period for private credit, and our private credit business is terrific and growing, and I think there are hopefully more opportunities to use that capital to support national security adjacent companies. I don't think it's realistic or sensible to think about private credit as eclipsing private equity, right? Companies are going to need equity and credit, and there's an appropriate balance to that. And we've been through a lot of boom bust cycles when if you over lever a company with too much credit, you wind up in a pretty unhappy place as the economy turns or the fortunes of that company move. So I think figuring out what the right level of that in this sector is, obviously public companies in the defense sector and the aerospace sector tend to be a little bit lower levered, and certainly our businesses that we hold in our private equity funds are lower levered to mirror that. But I think that there will continue to be healthy demand for equity and credit across the economy more broadly and in the national security adjacent space.
Yeah, great. Very, very helpful, David. Thanks. And we'll see where that goes. But it's very interesting to see the increase and now sort of even mixture of credit and equity at multiple firms. Let's take the lens to earlier. You talked about the aerospace and defense area sort of being a good neighborhood to be able to be in. So let's talk as a team here a bit about get to the brass tacks here. If I'm a company and I would love for Bain or AE to acquire or get a large stake from Insight, what are the things that you're looking for? What makes me attractive and actionable for each of you? Daniel, would you mind kicking us off?
Sure. Look, I think regardless of the sector, we generally are looking for businesses that are winning in good industries for reasons we think are enduring, but where there's also a good to great story that we can partner with a great management team to help accelerate. And so, that applies in the A&D world just as much as in any other industry. We look at sectors that have strong returns on capital, businesses that have real competitive moats, and management teams that are there for the long haul and interested in improving. We think we usually there are one or two things that we can identify with a management team that they can really focus on over the next 3 to 5 years to bring the business to the next level. And so when we find teams that have a similar outlook and approach and are looking to identify those, handful of really high value levers to take a business that's already really successful and make it even more successful, that's typically the sweet spot for us.
Richard.
Yeah, I mean, in the national security domain, it's interesting because we're kind of figuring it out as we go along. Typically, and I'd say, maybe it's helpful to map the difference between, the vast majority of our business and heritage, again, is in business to business software. And so when we show up, usually, there's revenue, it's growing pretty materially. It can be as little as, single digit millions of revenue. It could be as much as hundreds of millions of revenue. But usually the growth is at the very high end of what you would see for businesses of those whatever stage of scale that they're at. And the simple reason is there's a good product and a good market, and there's a lot of pull from the market. And then the goal is to go add more push and then build it so the whole thing is a real company versus just a bunch of people pulling and pushing. In the national security domain, it is really uniquely hard because whereas in a software application, you can go, it's got software, business software is the best business model in the universe. I mean, it just all recurring revenue that renews at 95%. Most of those customers will expand, so you could do nothing, not add a new customer, and you're going to grow. And you produce phenomenal gross margins and EBITDA margins and return on invested capital, and the balance sheet is just a warehouse for cash, and it's just a beautiful thing. In the national security world, every dollar of revenue you're going to see is not from a permanent contracting vehicle until many years into the life of it. And so you'll have revenue and validation, but it's probably more in effect non-dilutive capital than it is actual true revenue, the way I would look at it in a software company. So what are you looking for? What you're looking for is substantive progress in terms of, yes, we are getting these points and we are getting, we've done all the different acronyms that my colleague here would rattle off better than I would in this group, is probably more versed in than I am. But, whether it's the different classes of cyber, blah, blah, blah. And then, you have all these new vehicles that are popping up for the Valley of Death bridging. Again, it's all good to provide capital, but it's not real revenue. What you want to see is progress. I'm making progress. I'm getting validation. I'm making things possible. And I'd say the second thing is very strong connection to the end user and the end user value prop. If I look at what Hawkeye or what Shift 5, two of our national security investments have done, they are doing that in spades. And then the third thing would be to be able to visualize in some way, shape, or form how there will be a significant return on invested capital, because during these awkward teenage years, these things are ugly. And I mean, look, even the bigger versions of this, the Andurils and the Shields, are burning tons of money. And so you really got to be able to visualize, how does this turn? And all these things could take different forms. It could be a much smaller company, it could be a much bigger company, it could be something in between. But those are the key things that we're probably focused on.
Yeah, Richard, I gotta ask, as juicy as the SaaS and software world seems, why spend the time trying to figure out the national security model? You are, so why?
Yeah, I ask myself that sometimes. The short version is um, because I want to see if it can work. Because we have made a couple of investments that will work. And the right answer may end up being, this isn't going to be a big, in our capital allocation, portfolio construction spreadsheets and whatnot, it's going to be a sliver. And maybe that's the right answer. But, we are stewards of other people's money, so it needs to make the same return on invested capital hurdles that everything else has. And frankly, I think the hurdle rates are higher here because of all the stuff that I just complained about. But I think there is that orientation to trying to see if we can do it to make money for our investors and do some good for the country.
Yeah, thanks, Richard. Appreciate the transparency there. Probably good to turn it to Kirk now, who might have a more larger focus percentage-wise on the aerospace and defense world than perhaps our other guests here today. So, Kirk, what to you makes a company that's interested in being acquired or invested in actionable and attractive?
Yeah, I'm asking myself why I'm not doing B2B software, but no, we similar to what you said. Look, we're looking for great teams, enduring businesses, companies that are critical to the supply chain that they're in or the customer they're serving, right? And I think that's core to us. Like if you don't have if you might have the best idea, the best business model, best product, but you don't have a great team, a great manager, then it's probably not going to go well. And I think we've experienced that in our history. I'd say the other thing is that and theme we've already hit, right? We look for companies that have a rich history or a product that works and people want, but they have a scaling issue. They need help sort of taking that next step. Whether that's a York space where they had history of making a couple satellites a year, but now they need to make dozens. They need to make hundreds, right? And we have expertise in our firm scaling operations. We have expertise in our firm scaling supply chains. How do you do that in an efficient and a resilient way? And I think that's where we are best served to invest behind companies and invest in companies. So those are probably the 4 criteria we focus on.
Yeah, thanks, Kirk. David, last word on this question.
Oh, I mean, I think I'm joined here by 3 of the best investors in the sector and maybe any sector. So I don't have a lot to add to what they said. I think everybody looks for good companies and tries to use the things that are unique about their firm or themselves to find differentiation. I mean, at Blackstone, one of our strengths is our scale, right? As the largest investor, potentially in the world, certainly in alternative assets, we have the ability to bring scale to help our partners travel that journey faster. And as I think everybody on this panel has already said, that is a long and complicated journey that is more complicated inside the national security adjacent businesses because of the challenges associated with managing some of the customer and procurement dynamics. Ultimately, though, I come back to why we're all sitting here, right? Which is that we believe there are good opportunities to be found here. It's important that the capital go to these companies, and I think the fact that you are seeing more and more investors like Kirk specialize in this space and more capital from large institutions be dedicated to that space is an indication that at least some of it is working. And some of it's going to work and some of it's not going to work. And we're going to use those lessons to figure out how to make it work better. I think for Blackstone, national security adjacent opportunities will always be a fraction of what we do. But I'd like to see it be an important fraction and all of those opportunities succeed. And so as long as there remain opportunities to do that, I think we'll continue to to plug away and try and use our scale and resources to have conversations with folks in the customer community that want to talk about how to bring more private capital to solve both general acquisition challenges and specific technology or program issues.
Yeah, thanks, David. Appreciate you rounding that out. Now the government, probably does some things well and sort of does a lot of things terribly, depending on sort of your viewpoint and different areas. So let's think for a minute. Spent some time working with those on the Hill, and Representative Calvert's been leading the charge on the so-called hedge strategy, the chairman of our Appropriations Committee on Defense, which in some sense is thinking about a different way to be able to acquire and mature scale technologies. A lot of what we've all been talking about here in this session, but to sort of get a bit around the process and to be able to solve it and partner with private capital to make it happen. We don't all need to respond to this. Maybe a couple of you that feel particularly passionate about it or have specific examples would love to see, what is a thing that or two that the government's getting really wrong in this area, and maybe something that should stay the same.
I mean, I'll take a stab at it. I think one thing that I think even in the quote you read, where I think it's villainized in the defense industrial base, is profits, right? And I think if a customer gets a better product, more of that product, and it's cheaper, yet the supplier gets a more profit, that's not a bad thing. that should be celebrated as a good value proposition to the customer, and that's how you attract commercial entities. That's how you attract capital into your ecosystem, right? And I think that's one thing that I think we could be doing better as a defense community, is recognizing that profits, again, should be a celebration as long as the customer is getting more of what they want and what they want on time and at scale. I think that is, again, a perception that I think needs to be changed. I think what's getting right, I think things like what the SDA is doing within Space Force, right? That is creating a competition and inviting new entrants into a domain that historically has been dominated by large legacy primes, and creating competition for others to enter in and testing out new technologies. And can these companies present new technologies at scale at a lower cost? I think is you're seeing it through the success of the SDA, right? Has been eye-opening, I think, for a lot of people. And I think you're seeing Lockheed and Northrop have to change their business models and how they think about developing technology and how they think about bidding on opportunities. I think that's something that the government and defense is getting right and should be replicated across other areas.
It's funny, Kirk, SDA was going to be my example as well. I think that that's kind of universally appreciated, but I think it similar to what you were saying on the things that it gets wrong. I think that speaking more from the generalist investor perspective, one of the things that makes investing in national security difficult when you get closer to the end customer is the lack of commercial terms. Where and I think that, by the way, is part of the reason why investing in this area has often been dominated by specialist firms historically, because we're used to thinking about supply and demand, cost position, delivering great value to the customer, and those sort of kind of basic economic metrics as indicators of whether a business is going to be able to be successful over the long term. I think when you're far back in the supply chain in defense, that tends to apply. But as you get closer to the end customer, the diligence activities that you conduct to really think about the outlook for a business are much more oriented around, is it on the right set of programs? What's the spending outlook for those programs? And you get into decisions that are potentially more idiosyncratic and less grounded in kind of unchanging economic realities. I think when there are commercial terms at play, it makes all of that easier because it surfaces the winners and it punishes the losers over a long period of time. So I think the SDA is a remarkable example of, you know, how commercial terms can both take cost out in order to deliver more product cheaper to the customer, but also attract private capital. You look at the capital that's being invested in beneficiaries of the SDA, it's pretty remarkable over the last year or two. And that's because it's allowed a number of companies to emerge that are really impressive, you know, profit growth businesses, but that's grounded in sort of a fundamental technology or cost advantage that's much easier to underwrite than a lot of the ways that, you know, defense businesses have historically made money.
Yeah, thanks. I've as one of the small number of voices 14 years ago, you know, starting calling for proliferated space architectures. I and a few others of us are currently updating our bio to include support from Bain Capital and AE Industrial. So appreciate that. Richard, did you want to get in a word? And then I got one final thing to wrap us up.
The things I would probably point to, if you look at the growth companies that are making substantive progress, and you know, the few that you've even gotten some permanent financing or permanent contracting vehicles, programs of record or whatnot in place, you end up coming across SOCOM and DIU, and I do think those are two good examples. And unfortunately, you know, they're small, nimble, relatively nimble organizations. I got to credit Ash Carter for kicking the bureaucracy in the butt by creating DIU way back when. You know, look, I think those are they've been able to move fast and actually get innovative technology in. I think you're also seeing, look, you know, Replicator's been kind of gotten a lot of flat incoming, I guess, pun intended, sort of, on it. But, you know, I got to give a deputy secretary credit for when you put something out there, it's going to force a reaction. And it's a reaction in the broad scheme of things of something that, like, look, just read the newspaper. Look at a Twitter thread from Ukraine. I mean, it's clear as day this stuff's important. And you are starting to see some leaders stand up and say, you know, look, this is really important. General Fenn, the current head of SOCOM, General Carrillo, the head of CENTCOM, have been standing up. And then, you know, the recently retired Marine Corps commandant and having a different vision for the Marine Corps. And then, you know, taking flack from all the former commandants coming down and basically chewing him out for 2 days, and him being very polite and said, nope, I'm still going to do it. You know, that's the leadership that, and if you go back to the 1930s and World War II, you know, how did we get carriers in place when people didn't want them? Well, there was this admiral and he knew this congressman. How did we get radar developed? Well, there's this guy, Vannevar Bush, and, you know, he just jammed things through. I think those are good examples of some things that are working in smaller scale. And I would just encourage folks that are out there to really lead.
Yeah, thanks. Thanks, Richard. And folks, there's many sort of people have different views on that. If I was interested, happy to go. You can go to my LinkedIn, look at the Defying Gravity paper. Got 4 areas and a bunch of examples over the last few years where we've moved and tried to make change happen. And so you can see some very practical, very specific examples there. We're Defying Gravity on LinkedIn. We need to wrap up, folks. So just quickly, I do want to go around the camera here and just very quickly, if you sort of want to make a final statement that you'd like to react to, or to say something is up and coming at your firm that you'd like to just say, let's just do that very quickly around the horn. Daniel, to you.
Sure. Well, maybe in the up and coming category, you know, one thing we are very focused on, and I'm very focused on at the moment, is increasing our exposure to A&D in North America in particular. You know, it's an area, I think actually commercial aerospace in particular is a really interesting area at the moment, given the combination of cyclical recovery that's ongoing, challenges in the supply chain that are creating really attractive opportunities for leading suppliers to do more for engine or aircraft OEMs over time. And in the defense side, I think the emergence of defense tech as a growth area, where you're seeing kind of new business models emerge farther back in the supply chain that are ultimately, you know, whether it's innovation in electronics or more software oriented. There's a lot of innovation happening right now and growth, and programs like the SDA kind of creating the opportunity for commercial success, to ride alongside innovative deployments into the defense arena. And so given all of that, we've made it a priority to really find another platform or two to invest behind in A&D this year. So hopefully there will be some good announcements on that front in the near future.
Yeah, fantastic. David.
Yeah, I guess all I would say here is I think that as you have more investors, particularly non-traditional investors in the industrial base, like those around the screen here, the communication is important. This isn't a sector that you can sort of travel in and out of easily. And so I think things like this and increased communication, which goes both ways, comes from the government and comes from us, is ultimately going to be a really important part of making this a success. So for those who are interested in the success of this enterprise or the effort around private capital in this sector, I think it's terrific to do this kind of stuff, and I think more of it should happen.
Thanks, David. Kirk.
Yeah, I think that one thing I'd like people to take away is, like, I think people around here on this call here are long-term investors in this sector, right? There's hype cycles that happen even within the sectors we focus on, whether that was space a couple of years ago. I fear a little bit of like defense tech. There's a hype cycle going on, right? I think what you're hearing around this screen is, like, we're investing in great businesses, enduring businesses that are critical to our defense industrial base, and that's where we're going to focus on this year and beyond, whether there's a hype cycle or not.
Yeah, thanks, Kirk. And to wrap this up, let me just thank each of you for the folks that review. I get the privilege of working with each of these folks. Trust them very, very much. They care about what they do, and they do fantastic jobs for their companies and the companies in their portfolios and for the nation. So thank you very much for providing the overview, and your transparent thoughts has been extremely useful and helpful. And thank you, viewers, for tuning in for us today. So with that, let me pass it back to David and to wrap this up.